Hello folks, Steve Lentz here with Discover Options and welcome to this edition of the Market Reports. This will be for the close of Monday, November 28th, getting ready for the Tuesday open on the 29th. Today we have two reports for you, the S&P 500 Condor Butterfly Timing Report for those of you that like to sell premium in a market neutral fashion. And then we have the S&P 500 Directional Likelihood Report for those of you more statistically oriented. Before we get going, just want to encourage you to subscribe by clicking on the button. Also, we have a free ebook that you can click on the link and get as well. Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. We'd love for you to get that. And let's get going. The condition finishing up for today. Yesterday was an upswing day, or that would have been Friday. Today was a downswing day, Monday, as you can clearly see. A higher high, higher low going into Friday, and then a lower high, lower low finishing up with today. We are above the 50-day moving average, and the stochastic is between 70 and 99. Now that creates a condition. Also, we're actually, I think we are below. Excuse me, I didn't put that. Let me just change this. This says below. Okay, there we go. We're definitely below the %D, the 3-day simple moving average. This combines into a current market condition that's very unique. It's occurred only about 130 some times going back to January of 2000. Okay, so we're going to take a look at those 130 incidences and make some conclusions moving forward. All right, now, just as an overview of the two reports, many of you like to look at this routinely, and you are familiar with the methodology already, so I'll give you just a brief overview before we get into the weeds on the methodology, which we do repeat every time we do this presentation. So the butterfly timing report right now shows a selling edge, an edge to doing butters and condors of 11.1%. Now, what does that mean? Well, basically what that's saying is that there is an edge of 11.1%. That's the difference basically between the percentage of favorable bars with the market condition we have versus the baseline favorable bars. It's more likely than usual that today's bar will end up being favorable for market neutral option premium selling, range trading through butters and condors. Okay, and so we'll get into the weeds on that, exactly how we calculated that, favorable bars and all that. So, but that's a pretty strong edge when you look at the past in terms of what other favorable moments have resulted in. Usually if you have a favorable edge, you're in the single digits, not the double ones like 11.1. It's pretty good. Okay, now for the statistical one, the market likelihood report, a lot of red numbers here, meaning that the volatility bands in the past out of these 132 occurrences have gotten struck in general less often. This is a picture of lower market volatility moving forward. Only 3 of the 18 calculations were blue, and even those were quite small. Some of the red ones are quite large in terms of how less often these bands were getting hit. So again, this is a picture of reduced market volatility moving forward. And when we calculate our bands using the SKEW adjusted VIX, again, we have a preponderance of red numbers, meaning less market volatility, the bands getting struck less often out of those 132 occurrences. Okay, so that's the picture. Let's get right to it then. Let's talk about the timing report, why we would like to look at it, the methodology, and then the current condition and the exact edge level. Why would you look at the Condor Butterfly timing report? Well, we're basically trying to find and monitor the current condition to see if it's a good one from a technical analysis perspective for putting these kinds of trades on. Very few people really talk about using technical analysis to do premium neutral or market neutral premium selling. And that's what we are really keyed on. So here you have an example where the market was starting to channel in a tight range, and if we had run it through our algorithms at the time, we would have come up with a negative edge, meaning it would have been better not to. That there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. And indeed, at that time, if you look forward, the market did go crazy on the downside. And, that's a cherry-picked example, granted, but I wanted to illustrate the point here that sometimes this thing can definitely telegraph some more volatile periods. Okay, so we have our current market condition that I just described. Let me make that darn correction again. All right. It's a unique condition. All right, and it's occurred roughly 132 times in the past. The question on the table for this report is this condition a good one for selling premium through range trading, butters and condors? Here's what we do. We like to study and understand the actual volatility, how much the market actually moves from a given close. We compare that in hindsight to what was implied at the time by the option prices, implied volatility. We compare the two in hindsight and determine if a given bar in hindsight was favorable or unfavorable. All right, so that's how we determine favorable or unfavorable bars. Let's take a look at actual volatility. You could take a given close, go forward in time 21 bars, and determine how far the market moved the farthest direction or the farthest amount away, either up or down. In this case, it went down 50 points from that close. That turned out to be about 2.4% of a down move. Okay, and we can monitor that in a little indicator down there that you see. Now, the question at the time was, what market move was being implied at that time? It actually moved 2.4%, but what were the option prices implying at the time? And if you went and looked at the VIX, it was implying a 4.4% move at the time. So the option prices implied more volatility than what actually occurred. In hindsight, that would have been a good time to sell option premium. In hindsight, right? So what we like to do is paint those bars in hindsight. We'll paint those blue and call those favorable. And those that are unfavorable are painted in red. Now those are painted red because the market ended up being more volatile than what was being implied. All right, so we like to carve these up into favorable and unfavorable bars. And then what we're going to do is ask ourselves what percentage of the bars going back, all 4,000 plus of them going back to Jan of 2000, what percentage of those were favorable? That's our benchmark. Then what we like to do is look at those 132 examples of our current market condition, of the bars that match our current condition that I just defined. What percentage of those were historically favorable for selling premium? Now look, if we go back to those 134 examples of those incidences in the past, and we discover that all of them turned out to be blue, well, we're going to then sell premium neutrally, butters and condors, very aggressively, right? What if all 132 of them turned out to be red bars? And they were unfavorable, where the market moved more than what was being implied. Well, we would definitely back off and not do butters and condors, right? So there's going to be a difference between historically what the percentage was and then what the market condition of those 132, what those ended up being. So here we go. If you go back to Jan of 2000, all 4,200 plus bars, of those, 65.2% ended up being favorable for selling premium neutrally. 65.2%. Now, of the bars that match our current condition, okay, what percentage of those were favorable? Okay, 76.3% were favorable bars of those 132. Not too bad. Now, what that means is we have an edge of 11.1%. Okay, meaning that there's a greater percentage of the current market condition compared to baseline. So there's there's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices at this time. So that is the timing report for the butters and condors. Statistically it's favorable. Does that mean you're going to make money? No. Look at that, 23.7%. Of those 132 bars, 23.7% were unfavorable. were unfavorable. So you could run into a market condition. You could run into a situation now where, that's about a quarter almost. The 1 in 4 times it pops up and is unfavorable, you're going to have to do a little, adjusting and all that. Okay, whatever your methodology you use. We teach our own version of this in Discover Options of rolling condors and butters and all that. But just be aware that right now with the current market condition, you're looking at an edge. Doesn't guarantee you're going to make money, of course, but at least going into this, you have an edge if the past plays out. Okay, before we get to the other report, I want to remind you at Discover Options, we have a fantastic curriculum taking you from beginning or intermediate levels up to an advanced level, capable of even managing money. We have some great mentors. We've had money managers come to us for help, and we have our mentors that are professional option traders from the floor. They know what they're doing, and they will walk you through. We operate exclusively on a one-on-one mentoring relationship. No one joins your class, looks over your shoulder. You have the freedom to ask any question you want. No question is dumb. Okay, and we have a great set of curriculums here. Equity track for the stock, ETF, and index folks. Futures track for those of you trading futures options. And check us out. Go to the website, check out the curriculum, and you can give us a call and we'll customize a curriculum for you. Okay, let's get to the statistical report on the market likelihood report. And again, we have the current market condition, and I want to correct this because I didn't want to stop the recording and go back and make the correction. There we go. Here's the question on the table. Since Jan of 2000, how often has this same condition occurred? And what did the market do in terms of direction and volatility? Did it go up, down, or wobble around and not go anywhere? I mean, if we find out that out of those 132 times it ended up being, up, after 5, 10, or 15 days, well, we're going to jump on it from a bullish perspective, right? So that's what we do here, is we're trying to just look at what the market did in the past and see if there's an edge. We look at the historical distribution of price in general from those 4,000 plus bars. Here's how we do this. This is our methodology. We look at the historical broad distribution of price. Then we're going to look at the price distribution after our condition developed. We compare the two to see if there's any edge going on here in terms of direction or volatility. All right, so let's get right to it. How do we determine the distribution of price? We use volatility bars, basically. Set one standard deviation from each bar's closing price. I set these out 5, 10, and 15 days. Measured one standard deviation from the close using a 20-day historical volatility number. Now these are log-normally distributed, so I've got 3 bands above the close, 3 bands below the close, and the question is does the price move and hit any of those bands in the ensuing 5, 10, and 15 days? Here's an example, okay, just to show you. Here are 10-day bands set from the close. They're set one standard deviation from the close, and the question is, here, let's just draw these bands to give you a good idea what we're talking about. Here's the upper band set out 10 days. Here's the lower band. The question is price going to go up and hit the upper band, the lower band, or wobble in the middle? Now, in this particular case, it went up and hit the upper band that was set right there. You see that? So in our database, we note that for this close, price hit the upper band. Now we have the close set over here. So let's take a look at this. Upper band, the lower band. The question is in the next 10 days, does price go down and hit the lower, go up and hit the upper, or wobble in the middle? Okay, let's take a look. And we see that it tried to go down and hit this lower band and it failed to. So we say in our database that it hit neither. It hit neither band in that case. Now look, historical distribution is determined like this: is from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. So when you look at the results here, about 4,222 closes going back to Jan of 2000. Price hit the upper band 29.3% of the time, the upper 10-day band 23%, the upper 15 22.8%. On the lower side, it hit the lower 5-day band 29.6%, the lower 10, 29.4, the lower 15, 32.2. That is the baseline distribution of price. It quite often also stayed in the middle and hit neither band, but we see now a baseline distribution of price from Jan of 2000 to November 28th. Now what do we do? Now that we know this baseline, we're now going to understand the distribution after our condition develops. And then if there's a big difference, we're going to note that there's an edge. So here's what we do. We take a look at each of those incidences, and here we have our current market condition on the far right-hand side with the green diamond. You can go back to July, August. Look at, there were 6 examples of the same condition occurring right there. You see that? So I'm going to look at the distribution as of the close. Also, what happens tomorrow if price ascends above today's high? What's the distribution in that particular situation? That'll give you a good edge, I would hope, a good leg up in terms of defining what the likely distribution is in the future. And then if price goes below today's low, what's the distribution there? So we're going to look at it from all those perspectives. As of today's close, the distribution moving forward, take a look at this. Take a look at this. It hit the upper, out of these 132 examples or incidences of our same condition, it hit the upper 5-day band only 22% of the time. That's 7.4% less often. So it's failing to hit the upper band. It hit the upper 10-day band about 2.5% less often, and it hit the upper 15-day band about the same, just a 1.4% more often. On the lower bands, it hit the lower 5-day band about the same. It hit the lower 10-day band a little bit less often, and it hit the lower 15-day band a little bit less often. All in all, you're seeing a picture of slightly less market volatility. There's not really a huge bullish or bearish bias, I would conclude, from this situation, from this example, from this perspective. Now, let's take a look. What if price goes above the high of today? If tomorrow it goes above the high, that occurred 51 times. If it does that, of those 51 times, it really failed to hit the upper 5-day band. Look at that. It's already overbought. It's like it just fails to even go up to that 5-day band and strike that. Another full 5-day standard deviation. It's failing to do that in a great measure. It fails to hit the upper 10-day band as well, and to a lesser measure, it fails to hit the upper 15-day band. So it's really failing in the short run to hit those upper bands. On the lower side, okay, it fails to hit the lower at a lesser degree. On the 15-day band, it really fails to hit that. Okay, so again, reduced market volatility all in all. Now, if price goes below the low of today, tomorrow, if it goes below the low, you have the upper 5-day band getting hit less often. And then you're kind of looking at a scratch for the 10 and 15. On the lower bands, it's hitting the 5-day band less often and a scratch on the others. All in all, folks, a picture of reduced market volatility. I'm not going to lean bullish or bearish here much on this. Now, sometimes what I like to do is to repaint the bands using a SKEW adjusted VIX number, with the out-of-the-money calls having lower implied volatility than the out-of-the-money puts. Okay, the upper bands are going to be positioned a little bit closer to the close than the lower bands. So when we recast the bands using that, all right, again, you have a similar picture, and you can study these numbers. Just hit pause and study the numbers. You do have a little bit more bias, I would say, to the bearish side very slightly, only because you have some real fat figures over here and that the upper bands are failing to get struck in a greater measure here. Okay, so that's that. For those of you wanting a trading idea, let's look at a hedged bull put spread. The market's been really going up. We have the election behind us and all this stuff going on, and folks, it blasted off and it kept going, I think, quite a bit. And if you feel that there's still have some legs in it on the bullish side. Even with the reduced market volatility, you want to hedge you just want to be careful you don't get burned on the upside like what's happened. This is a picture of a hedged bull put spread. What we like to do is to take a look at the SKEW adjusted downside volatility, which is 14.8. We're going to go to option view and plug that number in right up here. It defines our one standard deviation at this. We do a bull put spread, a standard deviation out. We take that credit and do a little one lot a bear put spread right at the money to hedge it, but we want to do it so that there still definitely is a cash flow that gives us at least a 4 or 5% yield or so. When you take a look at the risk graph on this in option view, you have a real good picture. You can make 5% on your money going up. If it goes down, you have the hedge kicking in, and if it fails to go down a full standard deviation, you're going to look at making better than 3 times what it would make if it went up. You certainly want to get out, though, if it hits that short strike. Okay, so beware of that. And all in all, that was the picture of a good, healthy, hedged bull put spread that makes a lot of sense. If you want to make money, no matter which way the market goes, you'll lose money at expiration if it goes down a full standard deviation, clearly. But you certainly, if it goes up, no matter how much it goes up, you don't have to worry, which is nice. Here's a picture of the price chart with the profit area in green. All the market has to do is chop around for a little bit and you'll be in the green, which is nice. Just to make sure that if it, you want to protect yourself if it goes down and gets crushed down to that 21, better than that 2100 level there. All right, folks, I'm Steve Lentz with Discover Options. Thank you for joining us. We'll be back next week, or excuse me, this weekend here, probably Sunday night, with the same kind of information. Have a great rest of the week. Take care. Bye-bye.